In October 1987, markets around the world collapsed almost simultaneously. The Dow Jones fell 22.6% in a single day. More than the worst day in stock market history, it was a moment of strategic failure, not of men, but of machines. The term portfolio insurance sounds cautious. In reality, it was a high-stakes bet programmed into trading algorithms. Sell when markets fall. Sell more as they fall further. An automated feedback loop, blind to panic and blind to reason. Behind this safety mechanism stood some of the most respected financial institutions of the 1980s. Morgan Stanley, Goldman Sachs, institutional investors. All had embraced a logic that made sense in models, but not in reality. The system was designed to protect, and instead it amplified the fall. No enemy, no war, no scandal, just code, copying code, and then copying itself. It started small, a drop in futures, then a cascade. Machines reacted to prices, not meaning. They triggered more selling, which triggered more signals, which triggered more machines. Liquidity vanished. Traders couldn't execute. Phones didn't stop ringing, but computers didn't listen. The real problem? Humans couldn't stop it either, because they weren't in charge anymore. The idea of program trading was born from efficiency. Remove emotion, speed up execution, optimize risk. But that optimization assumed a normal world, and markets aren't normal, especially not when everyone runs for the same exit. By the end of that October day, $500 billion had vanished, and yet no one went to jail. No law was broken. The system had worked exactly as it was told. That was the problem. Some analysts blamed the Federal Reserve's prior interest rate signals. Others pointed to global macro imbalances. But the most chilling explanation came from a handful of market physicists. The feedback loop was mathematically guaranteed to crash once enough traders used it. In other words, the market wasn't attacked. It committed a kind of programmed suicide. Now look again. In 2025, more than 80% of trades on U.S. exchanges are executed by algorithms. AI systems, trained on past price behavior, now control trillions in capital. Their logic is more complex, but still recursive. They learn from each other, mirror each other, amplify each other. The pattern from 1987 wasn't a glitch. It was a signal. And now imagine that same recursive logic, but faster, global, and learning in real time. What happens when artificial intelligence panics? Who stops it? Who even sees it? The ghost of 1987 is not in the past. It's alive in the source code of modern finance. To understand how it all began, we need to return to the financial architecture of the early 1980s, a period that looked stable on the surface but hid a profound shift underneath. The United States was emerging from a decade of inflation, stagflation, and deep structural anxiety. Paul Volcker, as chairman of the Federal Reserve, had crushed inflation with record-high interest rates. The cost? A recession and soaring borrowing costs that restructured the behavior of corporations, banks, and households alike. But with inflation tamed, a new model began to take shape, one built not on productive growth, but on asset price expansion. Equities became the preferred path to wealth. Debt was no longer the enemy, it was the fuel. In this environment, the market didn't just recover, it exploded. Between 1982 and 1987, the Dow Jones Industrial Average tripled. Wall Street was electrified. New financial instruments emerged: index funds, futures, and derivatives. Sophistication became synonymous with automation. And in this gold rush of financial engineering, one idea took hold more strongly than any other: that risk could be managed by algorithms. The logic seemed flawless. If you could use computers to model volatility and pre-program sell orders when markets dipped, you could insure your portfolio against catastrophic loss. The technique, known as dynamic hedging, promised to replace human fear with mathematical control. It wasn't just accepted, it was celebrated. Firms like Leland O'Brien Rubenstein Associates promoted portfolio insurance as a revolutionary breakthrough. Institutional investors, pension funds, Even some university endowments adopted it rapidly. By 1987, over $60 billion in assets were linked to these automated hedging programs, a significant number for the time, especially considering the average daily trading volume of the New York Stock Exchange was only around $1 billion. The enthusiasm was bolstered by a broader ideological confidence. Markets were rational, models were predictive, and computing power was progress. But one detail was overlooked, or perhaps quietly ignored. These systems were all built on the same assumptions: that liquidity would always be available, that market participants would behave independently, and that price declines would occur gradually enough for algorithms to respond in stages. None of those assumptions were true. Underneath the optimism of Reagan-era economics, the foundation was dangerously interconnected. Everyone had been sold the same insurance, and no one had questioned who would pay the claims if everyone triggered it at once. It was a loaded gun disguised as a seatbelt. And while markets surged, so did complacency. Regulators were aware of program trading, but hesitant to intervene. The SEC had conducted hearings, but enforcement was minimal. Risk had been privatized, and responsibility had been abstracted. Meanwhile, outside the United States, other pressures were brewing. The 1985 Plaza Accord had realigned major currencies to weaken the dollar. Japan's stock and real estate markets were inflating rapidly. The global economy was integrating, but coordination remained shallow. In short, by 1987, markets weren't just bigger, they were faster, more entangled, and more fragile. The final illusion? That the machine age of finance had conquered panic. But panic, as history reminds us, does not disappear. It simply finds a new form. This is the context most overlook when they study the crash of 1987. It wasn't triggered by war, scandal, or fraud. It emerged from confidence, in code, in models, in the belief that the past could be predicted and tamed. And that belief became the blind spot. On the morning of October 19, 1987, traders arrived to falling futures and rising tension, but no one expected a catastrophe. In the days leading up to it, markets had already begun to shake. The Dow had fallen over 9% the previous week, a sharp correction, but not yet a crisis. Economists pointed to rising interest rates, fears of inflation, and growing trade deficits. But underneath, something more technical and more dangerous was unfolding. As prices slipped, portfolio insurance systems began to activate. These were not centralized systems, but decentralized, widespread models embedded across countless funds. Each operated independently, but all shared the same reflex: sell as prices drop. The algorithms were responding correctly, but the market was not prepared. Sell orders flooded the exchanges. Liquidity evaporated. The Chicago Mercantile Exchange, the nerve center for futures trading, became overwhelmed. Prices couldn't update fast enough. Bid-ask spreads widened. Some securities had no buyers at all. The fall accelerated. At 10 a.m., the Dow had already dropped 200 points. At 11 a.m., major mutual funds began dumping blue-chip stocks. By noon, the cascade became self-reinforcing. Brokers couldn't keep up. Market makers began to step back. Phones were jammed. Screens froze. Panic moved faster than communication. By the end of the day, the Dow had lost 508 points, a 22.6% drop. To put that in perspective, in today's terms, that would be equivalent to a single-day loss of over 7,000 points. No bomb exploded, no bank failed, no war began. The system simply turned on itself. And what's crucial is this: the largest sellers that day were not individual investors. It wasn't households panicking. It was the institutional layer, pensions, funds, endowments, using automated strategies designed to mitigate losses. The programs they trusted became the agents of collapse. At the Chicago Mercantile Exchange, traders remember a different kind of fear, not emotional panic, but mechanical panic. The algorithms didn't scream or sweat, they simply sold, more and more, faster and faster, and no one could turn them off. It was the first market event where human decision-making was too slow to matter. The SEC launched an inquiry. Reports followed. Everyone blamed program trading. But few asked the deeper question: how did we design a system so fragile that it could be destroyed by its own safety net? The irony was sharp. Portfolio insurance, meant to prevent large losses, had created the conditions for the largest one-day loss in stock market history. Behind the crash, several mechanisms failed at once. First, the feedback loop. As prices fell, algorithms sold more, which pushed prices further down, triggering even more selling, a recursive spiral. Second, the illusion of liquidity. Everyone believed they could sell just in time, but when everyone tried, there were no buyers. Third, regulatory paralysis. The SEC had limited authority over futures markets. Coordination between the NYSE and the CME was poor. There was no circuit breaker, no global halt button. The machine had no off switch. And fourth, the herd effect, amplified by automation. These were not panicked investors following the crowd. These were programs responding to identical signals built on identical logic and acting simultaneously. Some economists called it the most rational crash in history. There were no rumors, no emotional waves, only perfectly logical systems doing exactly what they were told, until the system itself broke. In the aftermath, a few core truths became visible: that liquidity is not a constant, it disappears when most needed; that safety mechanisms, when widespread, become vulnerabilities; and that in a digital market, crashes don't need fear, they only need code. By the time markets closed that day, $500 billion in paper wealth had been erased. But the real loss was deeper, a quiet realization that control was slipping. This wasn't just a market crash, it was a systems failure, a warning written in numbers, not blood, and almost no one understood what it meant at the time, yet. To grasp why the 1987 crash happened and why it matters now, we need to look at the mechanism itself. The heart of it was an elegant idea with a fatal flaw. Portfolio insurance was a strategy based on dynamic hedging. It worked like this. If the value of your portfolio drops, you sell futures contracts to offset the risk. If the market keeps falling, you sell more. In theory, this creates a cushion. Gains on the futures contracts would balance losses on stocks. Simple, logical, controlled. But the problem wasn't in the math. It was in the assumption. Dynamic hedging models presumed a continuous market, one where trades happen in small, smooth increments, where buyers are always present, and where you, the seller, are never joined by millions of others doing the same thing at the same moment. That's not how real markets behave. In 1987, once prices began to fall, thousands of funds using similar hedging models began selling futures simultaneously. These sell orders were not based on new information or market sentiment. They were triggered mechanically, a pure function of price levels crossing certain thresholds. That's the core of the feedback loop. Step 1, market drops. Step 2, algorithms sell futures. Step 3, futures decline further. Step 4, that fall spills over into the equity markets. Step 5, equity markets drop, triggering more hedging. Repeat. And here's where things turn structural. Futures markets, especially the S&P 500 index futures, are deeply connected to cash equity markets. Institutional investors use these contracts to hedge broad portfolios. But in moments of stress, the selling in futures puts downward pressure on stock prices. That triggers yet more algorithmic selling, and the spiral accelerates. The market becomes a hall of mirrors. Each system is reacting to the others. None of them see the whole. The illusion of safety dissolves. Now add volume. At the time, program trading accounted for roughly 10 to 15% of NYSE volume. But on Black Monday, it dominated the order books. Market makers couldn't absorb the flood. Liquidity, normally thin at the best of times, disappeared. Bid-ask spreads exploded. Quotes lagged. And buyers disappeared. Why? Because everyone was trained to react to volatility. And when volatility spiked, the reaction was always the same: step back. So the machines kept selling into a vacuum. There's a crucial insight here. The mechanism was not a bug. It was the expected result of rules obeyed too precisely. And in that precision lies the danger. A system that responds to falling prices by selling will, under stress, generate its own gravity. It doesn't stabilize the market, it accelerates the decline with mathematical certainty. Worse, this is invisible in calm periods. When markets rise, portfolio insurance remains passive. It looks harmless. But when stress hits, the hidden mechanism awakens, and it moves faster than any human response. This is what engineers call a latent instability, safe under most conditions, catastrophic under the wrong ones. And it gets worse when participants don't know they're synchronized. In 1987, no one had full visibility. Each fund thought it was acting independently, but the logic embedded in their code was nearly identical. And that meant the system was not diversified. It was tightly coupled, prone to cascade. The real danger wasn't any single decision. It was the structure, a vast, interconnected web of identical reactions waiting for a single trigger. And once triggered, the mechanism ran to its conclusion, fast, blind, irreversible. The same logic that promised to protect portfolios ended up magnifying their destruction. That's how a 200-point dip became a 500-point collapse. Not because of emotion, but because of automation. And the scariest part? None of these mechanisms had disappeared. When the dust settled on October 19, 1987, the headlines focused on numbers. 22.6% lost in a day. Over $500 billion in market value wiped out. But the deeper consequences unfolded quietly in how systems were rewired, how power shifted, and how risk was silently redefined. Start with trust. After the crash, institutional confidence in automated strategies didn't vanish. It morphed. Portfolio insurance was criticized, yes, but its core logic that risk could be outsourced to code was not abandoned. It was refined, rebranded, and eventually folded into the DNA of modern finance. The immediate aftermath saw temporary reforms. The SEC introduced circuit breakers, automatic trading halts if the market drops too far too fast. Coordination between futures and equity markets improved. Program trading was scrutinized. But these were surface corrections. No structural shift occurred in how trading algorithms were designed. No limit was imposed on recursive logic. The system didn't reject automation. It absorbed the lesson and evolved. The financial elite doubled down on complexity. Throughout the 1990s, new derivatives, faster algorithms, and broader electronic networks replaced the slow human floor traders. Risk was no longer something to be seen, it was something to be modeled. And that meant the people managing trillions of dollars increasingly didn't understand how their systems behaved under pressure. What began as hedging turned into speculation. What began as protection became the foundation for leveraged bets. Meanwhile, a deeper shift was underway. The crash marked a turning point in the relationship between the market and the Federal Reserve. For the first time, the Fed responded to a purely market-based event with emergency liquidity assurances. Alan Greenspan, just 2 months into his tenure as chair, issued a public statement before markets reopened on Tuesday. The Federal Reserve, consistent with its responsibilities as the nation's central bank, affirmed today its readiness to serve as a source of liquidity to support the economic and financial system. It was subtle, but it was a signal. From that day forward, markets began to assume that if volatility became too painful, the Fed would step in. A quiet psychological backstop was born. This became known as the Greenspan put. Investors began to price in central bank intervention, not as a possibility, but as an expectation. And so, the next consequence unfolded invisibly: moral hazard. As financial systems became more dependent on software, and as central banks grew more responsive to market stress, a feedback loop emerged not just in trading algorithms, but in policy. Volatility declined, confidence returned, markets rose again. But underneath, leverage grew, systemic risk grew, and concentration grew. Fewer firms managed more capital. Their strategies, increasingly similar, were scaled across global markets. The crash also taught institutional players a perverse lesson. In a crisis, first movers survive. Those who sell early, even preemptively, can escape the worst. But if you hesitate, you get crushed. This incentivized speed over stability. Algorithms were now designed not just to hedge, but to front-run volatility. The market became a battlefield of microseconds. And there was one more consequence, perhaps the most dangerous. The 1987 crash, while spectacular, was eventually recovered from. Within 2 years, the Dow had regained all its losses. The economy continued. No systemic bankruptcy, no political revolution, no crash of the dollar. This led many to believe that the system had proven its resilience. But in fact, the absence of a true reckoning created a false sense of durability. A mythology emerged, that markets, no matter how fast they fall, always bounce back. That belief now governs entire pension funds, government budgets, and household portfolios. Yet the underlying vulnerability of automation, of crowding, of recursive feedback was never removed. It was scaled. 1987 wasn't just a market crash, it was a rehearsal, a test run of what happens when control is ceded to models and models are mistaken for reality. And when the next crisis comes, with faster machines, higher leverage, and greater global synchronization, the mechanisms may look different, but the consequences could be final. Today, nearly 4 decades after Black Monday, the systems have changed, but the logic hasn't. What was once called program trading is now called algorithmic execution. What used to be portfolio insurance is now embedded in AI-managed volatility control strategies. The labels evolved, the core idea remained. Automate risk management, scale it globally, and trust the math. In 2025, over 80% of daily trading volume on U.S. equity markets is executed by machines. Not just pre-programmed instructions, but dynamic learning systems. Algorithms that adapt in real time. Models that read news headlines, detect sentiment, and place trades in milliseconds. AI doesn't just follow rules, it writes them, based on patterns it detects in the noise. But here lies the recursive trap. These models are trained on historical data, including past crashes, past rebounds, and past central bank responses. They are designed not to predict the future, but to exploit the past. And that past includes 1987. So what happens when every major trading system is trained on the same patterns, reacts to the same triggers, and mimics the same escape routes? You get synchronization without coordination. A crowd of machines all responding to each other, not because they agree, but because they've been trained on the same illusion. The illusion of safety in speed. In modern markets, latency is leverage. Firms spend billions to shave microseconds off execution time. Fiber optic cables buried straight through mountains. AI clusters stationed next to exchange servers. Entire business models built around being faster, not smarter. But what happens when every participant is fast? You lose the buffer of delay. Time, which once allowed human reflection, disappears. And with it, the chance to see what's really happening. That's where we are now. In March 2020, we got a preview. As COVID panic spread, global markets dropped at a speed that even shocked regulators. The fastest bear market in history. Liquidity vanished in moments. ETF spreads exploded. Treasury markets, the deepest in the world, seized up. And the cause wasn't just fear, it was mechanics, forced selling, automated unwinding. AI risk models that interpreted volatility as a signal to de-risk, triggering more selling. Sound familiar? It was 1987, rewritten in a new language. Only this time, the systems were more opaque. No one could say exactly which model had started the fire. No single trader pressed a button. And that made accountability vanish. The Fed intervened with force. Unlimited liquidity, unlimited bond purchases. For the first time in history, the central bank even bought corporate debt, and in doing so, extended the put to almost the entire capital market. The feedback loop had gone macro. Markets now expect intervention. They rely on it. They model it. Which brings us to today. In 2025, AI-driven hedge funds manage trillions in capital. Sovereign wealth funds use machine learning to rotate assets. Central banks experiment with real-time data modeling to guide monetary policy. Even retail platforms offer robo-advisors trained on pattern recognition. The entire market ecosystem is built not on understanding, but on optimization. But optimization, by definition, assumes stability, and that's the risk. The same logic that once told traders in 1987, sell when it drops, now tells AIs, de-risk when volatility spikes, rebalance if correlation shifts, follow momentum, respond to the crowd. But if the crowd is also AI and also optimized to the same goals, then every trigger is amplified. The illusion today is that artificial intelligence can prevent crashes, that smarter models mean safer markets. But AI doesn't eliminate reflex, it accelerates it. Imagine a million minds trained on the same past, reacting at the same time to the same stimulus in under a second. And unlike in 1987, today's market doesn't stop at the US border. AI funds operate globally. News spreads in seconds. Currency flows, bond sell-offs, commodity spikes, all are connected. And all can be amplified by AI decision engines that never sleep, never hesitate, and never question the context. What if one large fund's model misreads a signal? What if a neural net identifies a pattern where there isn't one? What if panic is no longer a wave, but a circuit? And who exactly would pull the plug? In 1987, humans could still pause the market. In 2025, the market may outrun the humans entirely. Because this isn't about the size of trades. It's about the speed of contagion. And now there's one more layer, retail algorithms. Millions of users connected through gamified apps. AI advisors offering 24/7 portfolio adjustments. Social media sentiment embedded into trading models. Meme stocks triggered by viral posts, instantly bought or dumped by bots. The distance between emotion and execution has collapsed. Then it was called program trading. Today, it's the entire system. Not visible, not local, not human. History didn't repeat, it scaled. They called it a fluke, a once-in-a-generation event, a lesson learned. But the lesson wasn't learned, it was embedded. What happened in 1987 wasn't an accident. It was a preview of a world where decisions are outsourced, speed is worshipped, and complexity hides fragility. We now live in that world. Only now, the traders are gone. The models are black boxes. And the panic, when it comes, won't announce itself. It will look like code. It will move invisibly, silently, until it's too fast to stop. And when it happens, the headlines will once again search for meaning. A virus, a war, a policy error. But the real cause will be older, simpler. The same recursive loop, the same blind logic, just more powerful. Every system fails the same way, slowly at first, then all at once. The difference today is that the first signal may never be seen, because the crash won't begin with fear, it will begin with code recognizing code. History doesn't repeat, it just waits for the same pattern to reappear in a faster machine.